Welcome to Kalkine. Today, let's delve into the art of asset allocation. Get ready to set sail through the seas of diversification and wealth-building strategies. So, what is asset allocation? Asset allocation involves diversifying investment portfolios across various asset classes like stocks, bonds, and cash equivalents to mitigate risks. Alternative assets such as real estate or commodities are considered outside these conventional categories. This strategy aims to balance potential returns and risk exposure, aligning with investors' goals and risk tolerance. Factors impacting asset allocation choice. Investors base their asset allocation decisions on three main factors: goals alignment, risk appetite, and planning cycle. 1. Goals alignment. Investors tailor their portfolio to match their financial goals, such as retirement or education savings. This ensures that their investments align with their objectives and risk tolerance. 2. Risk appetite. Risk appetite varies among investors, with some preferring safer investments for capital preservation, while others are willing to take higher risks for potentially greater returns. Understanding one's risk appetite helps in crafting a suitable investment strategy. 3. Planning cycle. The duration an investor plans to hold investments influences their risk tolerance. Long-term investors may tolerate higher risks for potential growth, while short-term investors prefer lower-risk options for stability. Example of asset allocation. Let's consider Sarah, who is planning for her retirement and has $20,000 in savings to invest for a 5-year time horizon. Her financial advisor recommends spreading her investments across 3 primary categories, with a distribution of 50% in stocks, 40% in bonds, and 10% in cash. Here's how her portfolio might look. Stocks, small cap growth stocks, $6,000, 30% of $20,000, large cap value stocks, $4,000, 20% of $20,000, international stocks, $2,000, 10% of $20,000, bonds, government bonds, $3,000, 15% of $20,000, high yield bonds, $5,000, 25% of $20,000, cash, money market, $2,000, 10% of $20,000. This allocation ensures a balanced approach to Sarah's portfolio, with 50% allocated to stocks, 40% to bonds, and 10% to cash, providing diversification and managing risk. Strategies for asset allocation. In asset allocation, there is no fixed rule on how an investor may invest, and each financial advisor follows a different approach. The following are the top 2 strategies used to influence investment decisions. 1. Asset allocation based on age. Age-based asset allocation tailors investment strategies according to investors' ages by subtracting their age from 100. This commonly advised method aligns investments with life expectancy, favoring riskier assets like stocks for younger investors, and aiming for a balanced mix of growth and stability over time. 2. Lifecycle funds asset allocation. In lifecycle funds allocation or targeted date, investors maximize their return on investment, ROI, based on factors such as their investment goals, their risk tolerance, and their age. This kind of portfolio structure is complex due to standardization issues. Hope you found the video helpful. For more content like this, make sure to subscribe to the channel and hit the bell icon.